Investing is not complicated, but most beginners make the same 3 mistakes before they even begin. Let's fix that today. Most Americans want to invest, but they never start. Not because they lack ambition, and not because they don't care about their future. They hesitate because investing feels confusing. There are too many opinions, too many platforms, too many headlines about market crashes and recessions. So instead of starting, they wait. And while they wait, inflation quietly reduces the value of their money year after year. In 2026, doing nothing is more expensive than ever. If you've been thinking about investing but don't know where to begin, this guide will walk you through the exact steps in a simple and practical way. Before you buy a single stock or open an account, you need to understand one fundamental truth. Investing is not about getting rich quickly. It's about building wealth slowly, consistently, and intelligently over time. The biggest mistake beginners make is thinking investing is a shortcut. It's not. It's a system. And systems work when followed with patience and discipline. When you shift your mindset from quick gains to long-term growth, everything becomes clearer. Step 1 is building a financial foundation. Before investing, you need stability. That means having an emergency fund. An emergency fund is simply cash set aside for unexpected expenses like medical bills, car repairs, or sudden job loss. Ideally, this should cover 3 to 6 months of essential living expenses. Why is this important? Because investing involves risk. The market goes up and down. If you invest money that you might need next month, you may be forced to sell at a loss. An emergency fund protects you from making emotional financial decisions. Once you have a small safety cushion, the next step is understanding the basic accounts available to Americans in 2026. The 2 most common investing accounts are a brokerage account and a Roth IRA. A brokerage account is flexible. You can invest and withdraw at any time. A Roth IRA, on the other hand, is a retirement account that offers powerful tax advantages. You contribute money after taxes, and your investments grow tax-free. When you withdraw in retirement, you don't pay taxes on the gains. For beginners who qualify based on income limits, a Roth IRA is often one of the smartest places to start. After choosing the right account, the next question becomes, what should you actually invest in? This is where many beginners feel overwhelmed. There are thousands of individual stocks, exchange-traded funds, mutual funds, and more. But the simplest and most effective strategy for most beginners is investing in broad index funds. An index fund is designed to track a large portion of the market, such as the S&P 500. Instead of trying to pick one winning company, you invest in hundreds of companies at once. This reduces risk and removes the pressure of constant decision-making. In 2026, technology has made investing more accessible than ever. Opening an account takes minutes. Most platforms allow automatic deposits and fractional investing, meaning you don't need thousands of dollars to begin. You can start with $50, $100, or $500. What matters most is consistency. Investing small amounts regularly over time is far more powerful than waiting for the perfect moment to invest a large sum. Another critical concept beginners must understand is compound growth. Compounding is when your investment earnings begin generating their own earnings. Over time, this creates exponential growth. For example, if you invest consistently and earn an average return, your money doesn't just grow linearly, it accelerates. The earlier you start, the more powerful compounding becomes. Time in the market is more important than timing the market. Now let's address fear. Many people delay investing because they're afraid of losing money. And it's true. Markets fluctuate. There will be downturns. There will be headlines predicting crashes. But historically, long-term investors who stay invested through volatility have been rewarded. The market has cycles, but over decades, it has trended upward. Understanding this helps you stay calm when short-term fluctuations happen. Another common mistake beginners make is overcomplicating their portfolio. You don't need 10 different funds. You don't need daily trading strategies. In fact, excessive trading often reduces returns due to fees and emotional decisions. A simple portfolio of 1 to 3 diversified index funds is more than enough for most new investors. Simplicity often outperforms complexity in the long run. It's also important to automate your investing. Automation removes emotion. When you schedule automatic contributions each month, you invest consistently regardless of market conditions. This strategy, known as dollar cost averaging, spreads your purchases over time. Instead of trying to guess the perfect entry point, you invest steadily. Some months you buy at higher prices, some months at lower prices, but over time, this smooths out volatility. As you continue your investing journey, focus on learning, not reacting. Financial news is designed to grab attention. Headlines amplify fear and excitement, but long-term wealth builders operate differently. They review their portfolios periodically, rebalance if necessary, and continue contributing. They don't panic sell during downturns. They don't chase trending stocks. They follow a plan. In 2026, one of the biggest advantages beginner investors have is access to information. You can research funds, compare expense ratios, and analyze performance data easily. But remember, information alone doesn't build wealth. Consistent action does. Opening the account, funding it regularly, staying disciplined. That's what creates results. Let's also talk about realistic expectations. The stock market does not guarantee a fixed return each year. Some years will be strong, others will be flat or negative. Long-term averages are more meaningful than short-term results. If you expect overnight success, you'll be disappointed. But if you approach investing as a decade-long journey, the probability of success increases dramatically. Taxes are another area beginners should understand at a basic level. In taxable brokerage accounts, you may owe taxes on dividends and capital gains. Retirement accounts like Roth IRAs offer tax advantages that can significantly improve long-term returns. Choosing the right account structure can be just as important as choosing the right investments. Finally, investing is only one part of wealth building. Increasing income, managing expenses, and avoiding high-interest debt are equally important. Investing works best when it's part of a broader financial strategy. The goal isn't just to grow your money, it's to build financial flexibility and long-term security. Starting in 2026 doesn't require perfection. It requires action. Even small, consistent investments can grow into meaningful wealth over time. The hardest step is the first one. Once you open your account and make your first investment, momentum builds. You gain clarity, you gain confidence, and over time, you gain growth. This is not about predicting markets. It's not about chasing trends. It's about building a system that works quietly in the background while you live your life. That's how real wealth is created.